The 2025 tax changes are here and they could save or cost you thousands in retirement. I'll show you what's changing, how it impacts your income, and the strategies you need to keep more money in your pocket. So let's get started. The first big change is the standard deduction, which reduces how much of your income is taxable. For 2024, the deduction for single filers is $14,600. For married couples filing jointly, it's $29,200. If you're age 65 and up, you get an additional deduction, which is $1,950 for a single filer and $1,550 for each spouse over that age threshold filing jointly. But in 2025, those numbers are increasing to $15,000 for singles and $30,000 for married couples filing jointly. And that age 65 and up additional deduction is also increasing to $2,000 for single filers and $1,600 per spouse filing jointly. And while these increases may seem small, they reduce your taxable income and could save you hundreds in taxes. We'll see later how this plays into a real-world example, but first, let's dive into ordinary income brackets. Now, this is one of the most misunderstood parts of the tax system. This is where many people get confused and think, well, if I'm in the 22% bracket, then all my income is taxed at 22%, right? But that's not how it works. I'm going to clear that up for you and show you how your income flows through each bracket, just like water filling up buckets in a waterfall. We'll also compare the brackets for 24 and 25 so you can see the impact of these changes. So to make it easy to follow, let's start with single filers and then we'll look at married couples filing jointly. In 24, the 10% bracket applies to taxable income up to $11,600. Then the 12% bracket applies to income above $11,600, but below $47,150. And then there's a big 10% jump in the bracket, and the 22% bracket applies to income above $47,150, but below $100,525. And the best way to visualize this is to think about a waterfall filling up buckets. When income fills up a bucket, the next income in that bucket is taxed at that rate. Income beyond the bucket will flow into the next one, and so forth. And again, to make this clear, let's assume someone has $100,000 of taxable income. This means in 24, they would pay $1,160 in that first 10% bucket, about $4,266 in the 12% bucket, and about $11,627 in the 22% bucket. So total tax on that $100,000 of taxable income would be $17,053. And again, even though their income puts them into the 22% bracket, not all of that $100,000 is taxed at the 22% rate. Now in 2025, the bracket percentages remain the same, but the amount of income within each bracket has increased due to inflation. And as you'll see, the 10% bracket moves to taxable income up to $11,925, the 12% bracket for income up to $48,475, and the 22% bracket for income up to $103,350. So in general, the ordinary income brackets have gone up by about 3% from 24, which is a welcomed increase, but given surging inflation the past few years, you may find yourself needing more income to maintain your standard of living, which is pushing more of your income into higher brackets. Of course, the exact same principles apply to married couples filing joint returns, except you'll notice that these brackets have larger amounts of taxable income that fit within each bracket. Now, these are just the ordinary income brackets that apply to things like wages, IRA distributions, short-term capital gains, and interest. There is a whole separate bracket that applies to capital gains. And by the way, in the description, you'll find my favorite tax cheat sheet for 25, so make sure to grab that below. Now, while you might think the capital gains are pretty straightforward, this is yet again another area where I see folks have a common misconception that causes them to not fully take advantage of the capital gains and qualified dividends bracket. For example, capital gains are created when you sell an investment within, let's just say, a brokerage account. Let's say you bought a stock for $5 and now it's worth $12. That's a gain of $6. Now, if you sold the investment less than a year from when you first bought it, that $6 would be considered a short-term capital gain and would be taxed at ordinary income rates we just discussed. However, if you held the investment for greater than a year before you sold, then that $6 would be considered a long-term capital gain, which gives you access to the special capital gains bracket. And this is the area I see most people missing. You see, capital gain rates are based on your taxable income, which includes things like wages, IRA distributions, Social Security income, interest, and more. So ordinary income can push you into higher capital gains brackets, but the reverse is not true. Things like long-term capital gains will not push you into higher ordinary income brackets. And there's some planning that we can do with this. And as we did in the previous examples, I'll start with the single filing status, then move on to married filing jointly. In 24, you can recognize up to $47,025 of taxable income while staying in the 0% bracket. So to reiterate, you could realize long-term capital gains as long as your taxable income is under $47,025, then you will pay a 0% rate on your long-term gains and qualified dividends. Now, taxable income over $47,025 but under $518,900 will cause your capital gains to be taxed at 15%, and taxable income over $518,900 will be taxed at 20%. In 2025, those rates go up by about 3% as well, with taxable income needing to stay under $48,350 to remain in that 0% bracket. And just as we saw for the ordinary income brackets, capital gain brackets for married couples have the same percentages, but the amount of income allowed in each bracket does go up dramatically. And again, this is when planning is so powerful, because if you plan your income right, you can create a nice retirement income while staying in that 0% capital gains bracket, something I'll discuss how you can do towards the end of this video. Now, before we dive into our next area of importance, it's important you know there is another tax that catches many people by surprise, and it's called the net investment income tax. Now, in a nutshell, if your modified adjusted gross income is above certain thresholds, then you could have to pay an additional 3.8% tax on things like interest, capital gains, and rental income, just to name a few. So here are what those thresholds are. And from everything I've been able to research, unlike ordinary income and capital gain brackets, which received an inflation increase to their thresholds, this bracket did not receive an inflation adjustment, which will likely cause more people to be impacted. And folks in this income range are typically the folks that we work with, where net investment income tax is a consideration and something we have to work to avoid. But let's move on to one of the most unforgiving brackets you may face in retirement, and that's the Medicare premium surcharge, also known as IRMAA. These brackets determine how much extra you'll pay for Medicare if your income exceeds certain thresholds. Because here's the catch with this bracket. Even exceeding a bracket by just by $1 can cost you hundreds more annually in premiums. And I found most people have no idea what determines if they will pay a Medicare premium surcharge or not. And imagine finding out you owe an extra $1,000 just because of a small IRA withdrawal or an investment gain. It's frustrating, but avoidable with the right planning. So here's how it works. IRMAA brackets are based on your modified adjusted gross income from 2 prior years. For example, your 2025 Medicare premium is determined based on your 2023 modified adjusted gross income. And this includes all sources of income such as wages, IRA distributions, dividends, capital gains, and even tax-exempt interest like municipal bond income. So in 2024, single filers pay higher premiums if their modified adjusted gross income exceeds $103,000, while married couples see increases above $206,000. So above that first bracket, that would increase Medicare Part B premiums by an additional $70 per month, and Part D for drug coverage an additional $13 per month. And so that's roughly, about $1,000 of extra premium payments for the year, even if you exceeded that first threshold by just $1. And remember, it's per person. So if you're married, you can double these numbers for your household. Of course, it only gets even more expensive in the additional tiers. Now for 2025, those thresholds are expected to rise slightly to $106 for single filers and $212,000 for married couples filing jointly. And again, while it's good that the tiers have increased to account for inflation, it's worth noting that the extra premium charges have also gone up as well. And so for 2025, above that first bracket, it'll increase your Medicare Part B by an additional $74 per month, and Part D for drug coverage an additional $14. So that's roughly an extra, $1,056 of extra premium payments for the year. But with all these updates, it still might be hard to wrap your head around, well, what do these changes actually mean? Okay, so let's take a look at a married couple in this situation, John and Mary. They are both over age 65. And what we're gonna do is just actually create the same income in 24 and 25, and then just see, well, how does that change their taxes if we keep everything the same except the years changed, so the brackets have changed, you get some inflation adjustments, etc. And so I've pre-populated some information like tax-exempt interest, taxable interest, dividends, just using some assumptions like IRA distributions, gross Social Security, some long-term capital gains, right? So I'm just filling in different income sources, and it gets their total income to about $128,250. Now, let's just assume they take the standard deduction, so that'd be $32,300. That put their taxable income at $95,950, which would create total tax of about $7,675. Now, if we do the same thing, we copy all the same numbers, but instead now we're looking at 2025, right? All the same numbers. Really, when we see the first difference is in the standard deduction, right? So as you may recall earlier, standard deduction is expected to go up next year. For them, it'd be going up by about $900. So we can see that increase there, which would decrease their taxable income by $900. And it would also decrease their total tax by about $406 because their total tax would be expected to go down to $7,269. But here's the really interesting piece, right? Because you might remember I said earlier, ordinary income and capital gain brackets are going up by about 3%, just kind of due to inflation adjustments. So a lot of people might see that and say, well, if the brackets are going to be changed by 3%, then I ought to be able to just change my income by 3% or increase my income by 3%. I'll be totally fine. That's a smart thing to do. Not necessarily. And as you'll see here, what this is showing us is that the effective tax on the next $1,000 of ordinary income in 24, they'd actually be taxed at a 27% effective rate. And the effective tax on the next $1,000 of capital gains in 24 would be 15%. But if we look at 2025, you'll see that the numbers are a lot lower. The effective tax on the next $1,000 of ordinary income is 12%. And it's actually 0% in 25. So how is that happening? And the easiest way to see this is if we look at their 2024 report, you'll notice that, okay, so in 2024, they would be in the 12% bracket. And due to their taxable income, because remember I said earlier, there's a difference between ordinary income brackets and capital gains, they'd actually be in the 15% bracket for capital gains. Now again, if we look at the exact same report, but now we're looking at 2025, they're still in the 12% bracket, but the big difference here is that their taxable income is $95,050, which is just below the 15% bracket for capital gains. So in other words, in 25, now all of their capital gains and all of their qualified dividends would be taxed at the 0% rate for federal taxes. And again, this is where just knowing the numbers can be so helpful, knowing and understanding, well, what is my income and how, might this change my tax situation in 25? Can I be more strategic? So I filled up my capital gain bracket here. Is there anything else I can be doing to make sure that I'm keeping below certain thresholds and actually keeping more income in my pocket? Because if they started increasing their income just by, let's just say 3%, now they're going to be pushing themselves maybe inadvertently in that 15% bracket when it could be more advantageous to stay in that 0% bracket if they can. Now, as you can see, taxes is more than just giving your CPA a big pile of documents to file your return and record everything that happened in the previous year. If you're driving down the road, it's good to look in the rear view mirror occasionally, but it's best to be spending most of your time looking through the windshield. And good tax planning is like looking through the windshield, constantly looking for opportunities and anticipating the changing landscape and how you can adapt. So in my next video, I show you how to do forward-looking tax planning to create $100,000 of retirement income and pay 0 taxes. And the best part is it doesn't require a Roth IRA or any special tax breaks or loopholes. If you're interested in how to get the most out of your retirement paycheck, I'll see you over in that video right now.